Hello everyone and welcome to your Glassnode on-chain report for week 48, 2022. What we're going to be looking at today is a concept of characterizing capitulation events, because we've obviously seen a very significant move over the last couple of weeks. And, we hear the word capitulation said very often, but really what we want to do here is just explore what it really means. And generally speaking, when you talk about a capitulation, you're looking at a mass expulsion of everybody who was going to sell and has then sold. And this is generally characterized by very large realized losses and essentially people who are just have had enough of this market and they're saying, get me out at any price. So let's get into it. So really, as the dust settles after the whole FTX debacle, really what we're trying to look at here is this event better characterized as an event, meaning that it's one of these major flush out events that, is it actually a continuation of a trend, or is it something that's changed the psychology of the market and made people start thinking about things differently? And generally speaking, I mean, you get these events all through bear cycles, but generally there's a point of maximum despair, a point when absolutely everything has been flushed from the system. And what's the great thing about on-chain analysis? We can actually observe many of these characteristics. We can see when the coins were acquired, we can see when they were disposed of, and particularly as we move into this era of much higher self-custody, these signals are going to become even more reliable. So what we're going to be looking at is the scale of the capitulation event, both in dollar terms and BTC denominated terms. We're going to look at the amount of damage done using realized loss metrics. And we're also going to look at the statistical significance. There's a handful of models that really broke below a series of two standard deviation moves. These are moves that are essentially significantly beyond the mean. They've kind of pushed well and truly beyond what we see in typical market structure. And as a result, this capitulation event really does speak to something that may well have shaken the market into a new way of thinking. Remember, a lot about on-chain analysis is mapping the human psychology over time. We're looking at how the market overall feels, baking that into a gauge on sentiment, and then using that to assess what may come forward. Now, just as a final reminder, this is our last day for the Cyber Week deal. So up to about the end of November 29th, you'll be able to get 40% off all advanced plans. And pretty much all of the metrics that you'll find in our new dashboard suite, which we've recently rolled out, you will find that they are almost entirely built for advanced members to try and give you the edge to actually describe and understand what is going on in this space. So anyway, let's get started and get into the analysis. So starting off with some price action, here is the major sell-off that we had following the FTX news. This is a combination of forced sellers and just sheer panic. People have basically seen a second version of Mt. Gox occur and all of the ramifications that follow it. So we can see that we're really still consolidating after these very large moves in price, whether up or down. Markets generally need to digest and consolidate and actually kind of work it out and assess where does the market go from here? What is the damage? Is it more lasting, or is it something that could in fact be that final capitulation splurge? And that's what we're going to have a look at over the next coming charts. So the first tool that I like to use to really, I guess, visualize these behavioral shifts. Remember, this is the thing I want you to take through this entire episode. We're looking for changes in human behavior. We're looking for where something has happened to make investors and the overall market start behaving in a different way. Now, the one tool we can use to really visualize this is the accumulation trend score. Now, what this model looks at, you'll see that these hot pink zones, these warmer zones are essentially areas where overall, if we look at the entirety of the market over the last 30 days, there's been a significant increase in their overall on-chain balance. Now, naturally, for every buyer, there's a seller. And some people get confused here, but what we don't include in the accumulation trend score are known entities like miners and exchanges. So you can kind of think about them as like the gray box in the middle. Somebody holds coins. When they distribute them, they send them to an exchange. They then move to a different cohort. So what we're looking for is overall, what is the net flow of funds? And as you can imagine, we've got a basically perfect scores for several days now. In fact, over a week. And this is a result of all of these coins being pulled out of exchanges. It's obviously a move towards self-custody. There's also a level of fear involved. There's all sorts of elements. But what I really want to help visualize here is we tend to see these events in a handful of circumstances. The first one we can see here is back in December and November 2018. So during these major sell-off events, almost contrary to what you'd expect, price halved during this time, but we had very, very high trend accumulation scores. We were seeing that people essentially saw that there was some kind of a discount there. There was obviously a whole lot of people who thought, get me out of this thing. But simultaneously on net, when you bounce it across the entire market, the net effect is we actually saw people stepping in and buying down here all the way down to 3,000. Now, it is important to remember, and again, we don't know when this bear market will end. We're trying to assess it using all the data ahead of us. But it is an important thing to remember that, like here in December 2018, like here again in March 2020, the bottom of bear markets is literally the worst that it has ever been for that cycle. So people, and then it does take many, in this instance, it was a rally, but then into multi-years of actually consolidation following this. So it is important to remember that these things are never instantaneous, but you can see this character change. Up here, this is distribution. We're seeing people lightening their loads, sending coins into exchanges. You can see that again through 2019. And here's our top up here in April and May 2021, all the way through. You can see here that this was entirely a distribution regime. And we've talked about this before, that this was likely the starting point of this bear. But the thing to highlight is that December 2018, we saw this sell-off alongside a change in investor behavior. March 2020 was the same. Here's that same concept in a bull market. Remember, you've got to factor in market behavior. Up here, these are people who thought this was accumulation of people after the all-time high that thought that we were going to go higher. Alas, we didn't. And then you can see that the psychology changed. Now, there's two other events more recently following Lunar, and then also the sell-off below 20,000 back in June, and then our current cycle. So you can see that these major sell-offs, what you would otherwise characterize as a capitulation event, typically signify a change in behavior. People start acting differently in the market, and all we're looking for here is that balance between that supply and demand, right? Where do we get that that matching between both sides of the equation, which will eventually put a floor in eventually. Now, if we then break that down into different wallet cohorts, this is where it gets quite interesting. So what I really want to highlight here is that on these bottoms, the December 2018, March 2020, and our recent sell-offs, note that the overall accumulation was actually quite heavy across all entities. We're talking about shrimps down the bottom here, all the way up to 10,000 BTC whales at the top. Note how it's pretty much everybody is involved. Same here in March 2020. Through this rally in 2019, it was a lot more interspersed. During the rally up to the peak, interesting that whales were actually the largest accumulators. This was institutions and the micro strategy of the world starting to get into the space, lots of trading funds. Shrimps and the fish to sharks really didn't participate anywhere near as much. See how this is actually quite top heavy? These ones here are quite bottom heavy. Interestingly, shrimps actually tend to do all right at picking this kind of thing, which is quite interesting. You can see that the June crash was almost the exact same market structure that we can see here back as the March 2020 crash. And you can see here, we've lit up all of the groups after a period of distribution. So you can see that the actual sell-off itself changed behavior from pretty much distribution across the board into something that is now accumulation across the board. So we are seeing that balance change. Now, the important caveat to all of this is remembering that this was an event that triggered self-custody. There is genuine fear in the market. That said, when people are pulling their coins off exchanges, particularly for Bitcoin, there aren't that many DEXs out there for Bitcoin. So generally speaking, when people are pulling coins off exchanges, they're not selling it. They're putting it into self-custody instead. So what we have to wait and see is, does this in fact evolve into a longer-term trend, or is this in fact an event? And just to really highlight that, we're talking about shrimps before. This is our shrimp net position change, and you can see this is actually consistent across many of these entities. We've talked about this over the last couple of weeks, but you can see that this is basically hockey sticking. This is the largest by far. In fact, I'm going to zoom this out on all history here. So the area chart you can see here is the 30-day position change of shrimps adding to their balance. You can see that shrimps are actually almost always in accumulation. They've always been growing their overall share in the network, which at least from my perspective is fantastic to see, right? These are the little guy who actually understands what Bitcoin is all about. But you can see that the last time we had this large spike here was in at the top, at the very, very top of 2017. Now, we came up and eclipsed that following the June sell-off when we came back down to 20K, but from a different direction. Obviously, this was a bull market. This was a bear. However, if we now zoom into our recent history, FTX has blown this out of the park. The amount of coins that shrimp are now adding to their balance, 95,300 BTC per month have flowed into shrimp wallets. It is the largest that we have ever seen by some magnitude. So it is quite a remarkable event, but it does really show that there's been a psychological change or a behavioral change following the FTX event. It has triggered a behavioral shift. And that's what's really important about on-chain analytics and really all market analysis. You're looking at the aggregate behavior of the people involved. And that's something that I think is really important. A lot of people don't quite understand that. It's all about understanding human psychology at a mass scale. So now we're going to get into actually measuring out what happened with the capitulation event, right? Now, when we talk about a capitulation, you're generally talking about two things. You're talking about the expulsion of anybody who is on the fence thinking about selling, someone who's going at 20K, oh, don't worry, if it'll recover, I'll exit then, and then it sells off, and they go, that's it, I've just had enough. Get me out of this asset. I hate this thing. So generally speaking, you see very, very large losses. People who bought their coins much, much higher, then distribute and just say, get me out of this thing. Anybody who was in profit and was even remotely skeptical just goes, get me out of this thing, and you get a complete expulsion of sellers. Now you can see here that a recent history throughout 2021-22 cycle, these bars just absolutely eclipse March 2020 and December 2018. So these really are, it's a new field up here, right? We have seen a new scale of capital enter this space, and it just gives you the actual scale of this thing. Now, what this is looking at is the weekly sum of realized losses, because naturally on an individual day, you can have large spikes, but what we're looking for is this an event or does it cool off soon after, which generally signifies that it's not a continuous flush out of people. You generally have that moment in time. Now we can see this event happen back here in the May 2021 sell-off. We had a major capitulation style event. We then had multi-month consolidation, which happened to be to the downside, but you saw that the losses deteriorated smaller and smaller, and we actually did manage to punch higher back up to a new all-time high. Now then there's the lunar collapse, which stood out as just about as big. The sell-off below June was much, much larger. This thing here got up to $19 billion. $19.6 billion on a single 7-day period. Just an extraordinary amount of coins moved that were acquired higher, being sold at a lower level. But you can see these generally correlate with major sell-offs. It's the trigger point that makes people panic and say, get me out. Now, our recent event, you can see, has actually been a bit wider. You can see these here. These were kind of a major event, which then cooled off very quickly. Here we had a much wider spread, right? So this thing here was a lot wider in terms of its actual width. We had a lot of people capitulating and just getting out of this thing. The uncertainty was growing. However, it has died off quite significantly. We're down here to 2.5 billion from a peak up here at 10.16 billion. So again, this is a great model. This realized loss metric, realized profit and loss, actually, the components and many different iterations of it. These are some of my personal favorite metrics. I use these all the time. I think they tell such an amazing story. You can also look at things like the P&L ratio, which is kind of mapping out where you've got a dominance of profit and losses, and that typically provides you with a gauge on when markets start to recover. But what we're seeing here is this realized loss metric has been a very, very significant event. There's been a psychological shift. It's of a grander scale than we've seen in the previous ones, even if the peak wasn't quite as high. So just something to take away and starting to kind of gauge what this capitulation event really looked like. Now, in terms of the overall market cycles, what we have here is the short-term holder cost basis. So the blue curve that you can see is the average price of all coins moved in the last 155 days. Now, I've seen some folks in the comments wonder why we use 155 days to bifurcate between short-term and long-term holders. The reason for this is that when we've got a statistical paper, which I'll put in the show notes, the 155-day period, and this has been validated by several other analysts, so this is something that can be replicated using data on chain. What we see is that when a coin has been unspent for that 5-month period, it is statistically very unlikely. Relative to everything else, most of the daily transactions are coins younger than 5 months. And those that are older than 5 months kind of have a very uniform and very unlikely probability to spend. So that's the reason why we actually do that divider there. It's based on statistical significance and looking at the probability of a coin actually being spent. Now, very, very simply, the short-term holder cost base, if you can think about this as the average price of coins that were recently acquired. Now, in a bull market, which are these blue zones, you can see that price generally hovers above it. These folks who are buying are essentially almost immediately put into a profit. It literally shows the shape of a bull market. People are in profit until we break down below it, and then it starts acting as resistance, and you move into these bearish periods of red, which is basically saying that every time someone buys or moves a coin, they're almost immediately into a loss. So what that creates is that kind of continuous or a continuation style event where people just continue to sell because they're never getting into profit, right? And until you get a market that's completely saturated with hodlers and no one else, then this trend can be expected to continue. You can see here again, very shortly after March 2020, we essentially moved into a full-scale bull, and this break here in May 2021 really ended that cycle. We had a brief poke back above, but really this is a little bit like the 2019 phase. It was a short-term rally that really didn't have any legs. And you can see that since that point, really since early December, we've seen 2021, we've seen that the market has been in this phase where no matter who was buying over the recent period, they were essentially plunged immediately back into a loss. So what's important to note here is that we have not retaken that level. And generally speaking, we see it retake this level at the start of a more bullish trend. There can be some little false hope signals, so you're looking for that confirmation. But as of right now, we do not have any break above. So at the moment, that trend continuation is kind of the base case until we get something of a significant and sustained break above the short-term holder cost basis, which for those in the audience, that's currently sitting at about 18,900. So that would be a level, and it kind of makes sense. That was our previous consolidation range. If we were to recover some of that ground, that would give a little bit of inspiration back to the market. So that's a level to pay attention to. Somewhere in that 18,000, mid 18,000s range is really that sweet spot for where you can start thinking about people who may have actually stepped in at these lows are starting to get back into some kind of meaningful profit. And that's really what you need for this market to turn around. We're not just there yet. Now, further analyzing this, there's another thing we can track. So we've got the short-term holder cost basis again here in pink or red. And then down here, we've got the all market cost basis, the realized price in orange. Now, historically speaking, when we have the market drop below the realized price, this means that the average coin holder across the entire supply is now underwater. So you can see this by these orange zones right down here at the late stage 2018 bear. And really since our sell-off back here in June, we've been underneath the realized price. Been a couple of retests, but we've never taken it and held it. So that means that the average Bitcoin investor, and by the way, this means that the damage is so great over time that even Satoshi's profits are not helping those who are currently underwater. So it kind of shows that even those lost coins, which are an immense amount of profit, are not enough to offset the severe amount of loss that's currently held in the market at the moment. So over time, these things actually evolve, and you have to factor in some of the historical coins, and we'll actually cover that in a metric that's coming up shortly. Now, the next phase of this, kind of the very, very late stage of bear markets, at least historically, remember, every market's unique. We don't know the future. What we're looking for is how did investors and their behavioral patterns change over time. What I really want to zoom in on now, let's just zoom into the 2018 market, and then we'll come back to this. So note here, this is where we broke down below the realized price. So the average market participant is at a loss, but note how the short-term holder cost base, it was resistance the whole way through, and then it really started to dive so significantly that the short-term holder cost basis broke below the realized price. Now, this will only happen during a true capitulation event. The gradient to the downside is basically showing that the average acquisition price of recently moved coins is much, much lower and getting lower at a greater rate. This is a capitulation event. This big, steep diving and then particularly breaking below the realized price, you can also think about this as max pain, because anyone who just stepped into the market, right? Some of you may have even experienced this. Your friend who's only just stepped in 2 weeks ago suddenly has a better cost basis than you do, and you've been here for 2 or 3 years. It's a brutal experience, but that is what max pain really is. And you can see here that this generally signified that there was a huge capitulation. Cost basis went from 30,000 or 5,000 all the way down to 3,000 or 4,000. In our current cycle, it's going from 60,000 down to 16,000. You're seeing that some guy who just stepped into the market has a superior cost basis, and he was buying coins off someone who capitulated from the top. So now let's zoom into our recent market history. You can see that we've been under that realized price since our June sell-off and really tussling with it ever since. But note that following that point, we got that massive diving down. Look at the gradient of this short-term holder cost basis. And here we are, it's got a second wind. It's now down below the realized price. So what this means is that the average acquisition price of coins that have been moved in the last 5 months have a superior cost basis, meaning a lower level, a higher probability that they're going to move back into profit than the average Bitcoin investor. So it's showing you that we've seen that flush out of coins in a very significant manner, and this market structure has played out in every previous bear cycle. And generally speaking, now one thing to note, we've been down here for only 20 days or 21 days so far. Previously, it was about 3 or 4 months before this thing actually was able to reverse and confirm. So it's one of those things where we've got that first early signal, but we're not there yet. We have to now watch and see how this plays out, because again, at the moment, this one here is telling us that we are still in a period of bear continuation, even though we do have signifiers that we have a capitulation that is meaningful from an investor psychology standpoint. And just to kind of bring a bit more light to this, here we're looking at the relative unrealized loss. So what this means is look at all of the market cap, how much of the market cap is currently holding underwater coins. Now, as you can see, through the process of bear markets, these tend to climb. Now, the reason that these are climbing is because there's over time an expulsion of anyone who didn't really want to be here in the first place. They came for number go up only, and those coins move to people who are quite happy and willing to actually weather the volatility, the downside, the pain, because they understand what Bitcoin is all about. So you're seeing this transition from the weaker hands back to the strong hands, and as we all know, that takes time. It's not an immediate process. Now, we have currently spiked up to about 57%. So that means that 57% of the market cap is held by people who are underwater on their coins. It's significant, and you can see it compares to our 2018 bottom. It compares to our 2015 bottom. This is now a very, very significant portion of the market that's underwater, and we're also seeing that doesn't even account for those who got flushed out. So if those who just recently capitulated out, if they didn't sell, this would be even higher because they'd be holding larger unrealized losses. So over time, you actually can see this. During our bottom formation here, this is actually a really important trend to pay attention to, because we haven't got in our current market, but this is something to pay attention to. Now, by the way, this model, relative unrealized loss, is a T2 metric as well. You'll see that we use these as often as we can in the week on chain to try and show you how to use these tools. So what you can see is that this was the peak pain, right? You get the maximum amount of unrealized loss. And price really didn't go that far. It was more or less sideways between about 3,500 and 4,000. It was basically trading sideways. But look how significant this divergence to the downside was. Even with a very, very small uplift in price, huge portions of the market were returning to a profit, right? Because they're no longer an unrealized loss. They're now an unrealized profit. So the inverse of this is unrealized profit. So this here is actually a bullish divergence, in the sense that with very, very little price action to the upside, we're seeing fewer coins in a loss, which means there's a whole stack of people who accumulated down here. There's been an influx of demand as well as a process of seller exhaustion. So this bullish divergence here is actually describing that increase in profitability over the course of the market, even though the market was trading sideways. Down here, everyone thought Bitcoin was going to $1,000. Now remember, this doesn't necessarily have to play out again, right? This may not be the bottom. We may have to go through this once more. You can see we've had the spike higher. What we now want to be paying attention to is a significant downside on this with sideways or even a little bit of upside price action. Again, these are all things we can set ourselves up for to pay attention to. We don't know what's going to happen, but they're tools to help us gauge what's going on as it happens. So I mentioned before Satoshi's coins and all of the lost minor coins and things like that are basically going to always be in profit, right? Until they're spent, they're always going to be in profit. So what we've done here with our adjusted MVRV, now this is a really cool metric where what we've done is we've removed all of the coins older than seven years. So we don't care about how in profit they are. And what we're now looking at is, of all those coins minus 7-year-old plus coins, we're just looking at really what I've been calling the actively traded supply. We're looking at only those coins. What is the current held profitability of those? Now, we are currently down here on the adjusted MVRV of 0.61. So that means that 39% is the average loss held by the market because it's below a level of 1. Now, you can also see on this chart these purple bars. These are the periods in time where the market has been in a worse position than where we currently are. Now, you could probably notice something kind of consistent around these. They were the Pico bottoms, the absolute lowest level that we've ever seen for BTC market cycles. So again, whilst we don't know what the future holds in store for us, what we can see is that this current level of profitability, and the reason I talk about profitability is that this is the incentive. When people are underwater and their portfolio is just giga red, that is their incentive to say, get me out. There's some folks, the hodlers, who go, I don't particularly care about that red number because I'm looking much, much further into the future. So it's that transition of wealth, and there's a behavioral shift. What we're looking at here, these purple levels, are points in time when absolutely every seller who was going to sell had seen enough red that they just said, get me out. I'm calling it quits. I'm out of this thing. Now, this green chart down the bottom here is actually a really neat model. This one here is looking at the percent of history that have had worse conditions than where we currently are. Only 1.2% or 1.3% of the entire market has ever been at a greater loss than where we currently are. So it gives you a sense of scale here. We've only seen 1.6 days where it's been worse. Now, there's one interpretation of that, which is that, well, that's obviously not a good sign, and perhaps that means we're going to go lower. And of course, that could be true. There's another interpretation to say, well, that was sufficient pain in the market to flush out any and all remaining sellers. So we have to kind of look at all these models in context and try and assess, well, what is the most likely result? And that's why when we look at those models we just covered before, we can see the capitulation event, we can see the diving of the short-term holder cost basis, we can see the level of profitability that was enough to shake investor confidence in all previous cycles. And thus we have a bit of a framework to say, well, if it keeps getting worse, maybe that's not the best sign. But if it actually starts to improve in the rear view mirror, it suddenly all makes a lot of sense. Now, the last model, and this one's actually the metric of the week, just because I personally absolutely love this model. I think it's great. What we're looking at here is the aSOPR metric. So aSOPR is actually a really, really powerful tool in pretty much all weather. What it looks at is the average profit multiple. So a value of 1.1 means that the average coin that was spent realized a 10% profit. 0.85 means that the average coin that was spent realized a 15% loss. So values above 1 in profit, values below 1 in loss. Now, what we've done here is taken the 7-day moving average just to really smooth it out. That's what the blue curve is. And then what we've done is put some statistical boundaries on it. So for those of you who are not familiar with statistics, there's an average value, right, over the long term. Here we're using over a 4-year period. What's the average aSOPR value over a 4-year period, over a Bitcoin market cycle? Then what we do is we say, okay, there's a thing called the standard deviation, which is basically how far has the rubber band been stretched away from that equilibrium, that mean average point. So when you're getting a 2 standard deviation move to the upside, it will hit these green curves. You can see here in 2017 at the top, profits being realized exceeded a 2 standard deviation move. Statistically meaningful, well and truly stretched above the mean, blow off top. We saw it again here in 2019, blow off top. January in 2021, not quite a blow off top, but by pretty much all on-chain metrics, that was where the exuberance just ran out, and we saw it in the accumulation trend score. Things moved into distribution from that point onwards. So again, psychological shift, change in behavior. Now to the downside, we also have a negative 2 standard deviation move, December 2018. March 2020, we actually didn't get there back here in May, June, July 2021. We almost got there in June, but we punched right through it down here at the FTX collapse. So again, we're looking at a whole series of metrics that are providing us with a little bit of confluence. And that confluence is that we have actually been in this almost exact position before. And you may have heard me say this in previous sessions. We are kind of in the process of dotting the I's and crossing the T's on a textbook Bitcoin bottom. Now, again, I don't know what is going to happen, what comes next. But certainly if we were to just map it against what we've seen in the past, the conditions that we currently have in terms of the realized losses, in terms of the unrealized losses, in terms of the supply dynamics, the redistribution characteristics, a lot of the behavior patterns that we've seen over the last couple of weeks, and actually really since June, all of those have essentially happened before. And where have they happened before? December 2018, March 2020, not quite here in May, but back here in during the FTX collapse. So we're starting to look for confluence. We're seeing lots of models that are telling us a very, very similar story, which is that it's pretty nasty out there. Now, that has 2 outcomes. It can shake the confidence to the point where we actually do have a new regime and Bitcoin's in for some seriously troubled waters ahead. But it could also be that final thing that expunges all of the tourists, everybody who is going to sell. We have to now track these models as we move forward to understand which one of these 2 outcomes is it. Right, we can start to play around with these models, and that's what we're going to be looking at in future episodes, so make sure you stay tuned. So thanks everyone for tuning in. As I said before, please do make sure if you are interested in getting a Glassnode Advanced subscription, what we are really doing is we're spending a lot of time rolling out advanced models and tools to actually really help people understand these tools. Some of the biggest feedback that we got is that there wasn't enough education, information, and guidance. So that's what our dashboards, and you'll find the dashboards in the link in the description below. Our dashboards have been redesigned to really give you those elements. Explain what the tools are, put them into a context so you know which tools to pick up to solve which particular problem. And as always, you can always jump into the comments and let me know if you have any thoughts. More than happy to answer those. So until the next one, I'll see you then. Cheers.